Small business loans, almost everything you need to know. The reason why I make the qualification about almost everything you need to know is mostly from a holistic standpoint, that as soon as I think I know everything, I've stunted my own growth in terms of my ability to learn anything new. So I make that qualification to make sort of a bigger point about the fact that we can always learn something more. And when it comes to small business loans and the lending process, what impresses me the most, frankly, about Fundera is that they don't just give you a product. They give you an entire educational platform where they provided a lot of resources that don't cost you a dime, which will help you educate yourself about the loans, the kinds of loans that your clients may qualify for, what would make them qualify or not qualify, and what sort of things you need to have prepared and lined up as you're applying for financing to give your clients the best possible chance of qualifying for the best possible loan. What I've done here and what you're about to see in this lesson is I've compiled from lots of different places where Fundera has provided us with this kind of information. I've compiled a template which you're going to have access to, which outlines very specifically 8 different types of loans and all the criteria that you'll need to know about so that you can help your clients determine which is the best option for them when they're going out there and looking for financing. Fundera, Course 20, Section 1, Lesson 2, Business Loans, almost everything you need to know. Take 1. Business loans, almost everything you need to know. And I sort of like that qualification because we can always learn more, right? The minute I think I know everything, I've completely stunted my own growth just by thinking I know everything that there is to know about anything. So, almost everything you need to know. There's always more you can learn. Fundera has provided a really great platform, I think, from an educational standpoint, which is, of course, where I sit and live, right? My whole thing is education. In fact, I tell any partner who wants to work with me that I make it clear that that's the sort of place in which I sit. I'm not going to market stuff. I'm going to educate people about stuff. And back of that, of course, is what happens anyway as a byproduct, which is marketing. If I learn about how something works and it solves a problem, I'm going to buy it. So anyway, Fundera, though, I'm so impressed with what they've done in terms of the platform that they've created, because it's not just about their product, which is amazing, and we're going to get deep into that in the next lesson, but it's about the educational platform that they've provided in terms of helping the small business community much better understand the nature of loans and business loans and how those work. So that's really what the focus is going to be. We're going to look at 8 different types of loans that you could potentially look into for your business in this lesson. We're going to talk about the different types of loans. We're going to talk about different levels of revenue at which you can expect to be able to get each type of loan. We're going to look at how long you need to be in business before you can expect to get each type of loan. We're going to look at what your credit score needs to look like. We're going to look at how far out you might need to be from any bankruptcies if you've ever filed one before you'll be able to qualify for one of these types of loans. And we'll talk about what the difference is between second position and whether or not it's allowed and what that means. The other thing that I wanted to do is I was doing my research for how I was going to do this course, and what I was going to be able to provide for you is I created a template based on a lot of this information that my good friend Meredith from Fundera had provided me with. I always ask, just send me links to as much as you can send me in terms of resources that might help me put this course together for you. And Meredith sent me links to a series of posts that she had written in a couple of different places on the web, and I went through them all, and I went through them very thoroughly. And based on, I think it was mostly all of it came from one post in particular, I put together this loan analysis template that, of course, you're going to see a link to it in the write-up if you haven't stumbled on it already. And as always with Google Sheets, you'll see it on a view-only basis, but if you click File and you choose Make a Copy, you'll be able to make your own copy of this, which will save to your own Google Drive, and it'll be completely editable. So then you can go in and play with this a little bit more directly. In fact, I'd encourage you to pause the video real quick right now and do that, because as always, when I'm showing you something like this, it helps if you can follow along. And that's how you learn from video. Of course, you pause and play and pause and play. So play a little bit of this, watch what I'm about to go through, pause it, go through it on your end, and just make sure you follow, make sure you understand. So what I did was I took the 8 different types of loans that Meredith had outlined, and the information that she provided based on the different types, and I put it into this grid-like format. And what's beautiful about this is you can start looking at this from the standpoint of if it's your own business or your client's business, where do they fit in? What are their annual revenues, right? So you can start actually sorting and filtering this list based on the minimum annual revenues to quickly weed out the ones that won't apply. If your company's brand new and they don't have $200,000 in revenues, then you can rule out the business line of credit. On the other hand, $200,000 or more, then you're not going to filter anything out based on this because you could potentially qualify for all of them. But if you've only been in business for 2 years, actually 2 years qualifies you for any of these, right? But if you've been in business for less than a year because you're brand new, then you're looking at some of these options, right? Short-term loans, invoice financing, and merchant cash advances, right? Minimum credit score. So you look at that. A lot of times in my experience, they'll ask you to personally co-sign the loan so that the credit score factor may have to be looked at a little differently because then your own personal credit comes into play. If you have really good personal credit and the business is brand new, so the business has no credit, all that can make a difference, right? How far out from bankruptcy do you have to be in order to be considered? So SBA won't look at you if you're less than 3 years out from your last bankruptcy. Hopefully you've never had a bankruptcy. But again, if you did, that's a consideration. Second position allowed, I promise you I'd talk about this. So what this refers to is, will the lender who's potentially going to be giving you the type of loan that you're looking at, will they accept second position? Second position simply means that somebody else has already loaned you money, which means they're going to be a priority creditor in the event of insolvency, right? So if you have to liquidate and pay people off, some of these loan types won't allow for the lender to be in second position. In other words, they'll have to be first position in order for you to be considered for the loan. So as you can see, a lot of these are sometimes it's allowed. Right? Sometimes they will allow second position. So that probably depends on the lender and your situation and, frankly, how confident they feel in your ability to repay them. Merchant cash advance sometimes requires it. Small business startup loan definitely won't accept second position. SBA loans definitely won't accept second position. Is accounts receivable required? Obviously, the invoice financing is where this really comes from because that's the whole nature of it. So obviously that one, accounts receivable, is a requirement for because that's the very thing that they're lending you money against. That's the collateral, is your accounts receivable. If you can't pay them, they'll collect the money from your customers. And everything else is no here except for this one, which is sometimes. So on a business line of credit, sometimes they will require that you have accounts receivable pledged as collateral. So obviously then accounts receivable has to be there. If you have no receivables, if you're an online store where you collect your money right away at the point of sale, then you might not be able to get a business line of credit if that's what your lender is requiring in terms of being your ability to pledge receivables as collateral. I've seen this where you have loan covenants, right? And those loan covenants are sort of those terms, certain requirements that you have to fulfill. So pledging accounts receivable might be one of those. The other thing I've seen is the need to maintain certain balance sheet ratios, and you'll have to submit your balance sheet and P&L regularly to the bank or the lender in order to prove that, for example, your quick ratio is, let's say, at a minimum of 2.0. The other thing is, will they require anything else? So I have this other requirements. So on the business line of credit, according, again, the information I compiled from what Meredith provided me suggests that you'll need to be profitable in order to get a business line of credit. And again, that makes sense. It all goes to whether or not they feel confident that you'll be able to repay them when they loan you the money. Here we have, because it's a merchant cash advance, this is where they're lending you money against what you're processing on people's credit cards. So in other words, before the money gets funded into your account, they will sort of put a lien on that, and they'll take a percentage of every sale you make in order to repay their loan. So in that case, you'll need to have, it looks like, at least $4,500 in monthly credit card transactions so that they'll feel there's something meaningful from which they can pull out their payments and get repaid. So those are just two of the other requirements that came up as I was going through all the different loan types and what they sort of look like in terms of whether or not you can expect that yours or your client's business will qualify for them. So in keeping with this, and this would be a good time to pause the video and just kind of review. If you haven't already, go through this, make sure you understand it, because this is a great tool you can use when you're talking to your clients about potentially looking for financing, right? If you followed along in the last lesson, then one of the keys to that was that I talked about how important it is to try and line up the financing before you need it, right? You should have the conversation with your client and say, hey, I know you're a new business. I know you're not struggling cash flow wise now, but that's why now is the time to line up financing, because should an opportunity come up such that we'll need access to cash, it'll be too late if we don't already have the financing lined up, right? That was the essence of it. So the next part of that conversation is going to be the answer to the obvious question that the client's going to ask, which is, okay, what kind of loan should I get? Right? In a perfect world, of course, my favorite would be to get the business line of credit, right? As food for thought, I want to throw this out there, that after doing this lesson, after preparing and researching so that I could put this whole lesson together, I went into it with a certain expectation, which, as it turned out, was confirmed, which is, and this is my opinion, of course, that the ideal financing that you would want to line up for yourself or your client would be a business line of credit. And the business line of credit is the best because any other kind of financing is sort of one time. I borrow the money, I pay it off, that's it. I can never use that financing again without reapplying. Whereas the business line of credit is revolving. It's also, because of that, a little harder to qualify for, and the interest rate also might be a little higher. All of that, of course, depends on lots of the other criteria. But if you're going out there and looking for financing or looking to line up financing for your client, and especially if you're doing it in the way that I laid out in the previous lesson, where we're doing things well in advance so that our client is in a good cash position and much more likely to be able to qualify for the best type of financing options out there, I would encourage you to really seek out a line of credit as the best possible option so that they can make use of that over and over again, and then they sort of have the vehicle that they need permanently in place to take advantage of any opportunities as they come up and as your clients create the opportunities for themselves that require some kind of cash infusion. And there's a number of reasons for that, but I think the most obvious one is that this way you use it as you need it and you repay it as you don't. Right, so you use it to cover, whatever working capital needs you have, to finance whatever you need to purchase, to take advantage of whatever opportunity is right in front of you, and then as the revenues come in, you pay that down, right? And so there's no fixed just borrow it, pay it off, and you're done. You can borrow it again after you've paid it off. That's the beauty of the business line of credit. It's like a credit card, but better. The rates are usually lower on a business line of credit compared with a credit card. So this is the conversation you need to have. Before you have that conversation, or as part of that conversation, you might want to be prepared with this very schedule so that you can speak really intelligently to your client about what their options are that are out there and which ones they may qualify for, right? So that's why I wanted to provide this for you, because I think it can be a really useful tool, especially when you're having that conversation. So what I did in the meantime to look at sort of examples of all of this was I went into a QuickBooks file and I dumped a sample manufacturing company balance sheet into a spreadsheet. So you can go through this, but really what I used this for was the creation of the next tab. Now I mentioned that some banks might require that you have a minimum quick ratio maintained on your balance sheet at all times. So this is a calculation you're going to have to do regularly if that ends up being the case. And then Meredith also talks about debt coverage in her post. And I thought that was really interesting and important to know. So I've included that here as well. And it's basically your cash divided by your monthly payment in terms of what you've borrowed, right? And so that's another ratio that might need to be maintained at a certain level. So what I did was I just pulled the line items out of the balance sheet just so you could see it more succinctly here in terms of the line items that we're concerned with when coming up with these specific calculations. And I'll usually do that. If you look closely at the formulas, you'll see that everything is just pulling from the balance sheet. So I could sort of summarize the information. Also makes it a lot easier to write the formulas instead of having to scroll up and down through, 60 different line items here, or a little less. So I just pull out what I need from the balance sheet to perform the calculation, and I put that all under the heading of ratio analysis here. right? So what do we calculate? We look at the quick ratio, which is your short-term assets divided by your short-term liabilities. So that's cash in your accounts receivable, essentially. In this case, we're short-term assets. We do not include inventory in a calculation like this because even though we like to think and hope that inventory is short-term, we don't know what might be obsolete in there. So when we're calculating the quick ratio specifically, we exclude inventory from the calculation. Any other short-term assets, anything we're very likely to be able to collect within 30 days, and if and when the need arose, we certainly can do that, and that's what essentially gets included here. So short-term assets, in this case, amounted to cash and accounts receivable. Then we look at short-term liabilities. Our accounts payable and our credit cards, essentially, is our total short-term liabilities. So then it's simple math. Take the assets divided by the liabilities, and that tells me how many times over I can settle my short-term obligations with my short-term assets. In this case, in month 1 here, I can do it 4 times, right? Because I have about 4 times as much in short-term assets compared with short-term liabilities. There's no complicated math here. It's very simple and straightforward. It's just a matter of going through it like I just did so that you really understand it. And I doubt anyone who's ever watching this video will have difficulty understanding this. Conceptually, again, it's just a matter of sometimes having somebody explain to you, and most times you say, oh, okay, now I get it. Yeah, that makes sense, right? So now we look at debt coverage. So what we're looking at is, let's say, our monthly payment on our debt, and I'll get to how I came up with this in a minute. But let's say we decide that our monthly payment is $2,000 per month. So how much cash do we have to satisfy that? Cash divided by the monthly payment, right? So in this case, at this point in the timeline, we're looking at plenty, right? I have cash divided by the monthly payment. My debt coverage ratio there is 24.69 because the monthly payment we're saying is $2,000. So take the total short-term assets, or actually the cash portion, right? So that should be F3, and it is. If you look at the formula, it's F3. It's just the cash line divided by the monthly payment, which I pulled into here by formula from our effective interest schedule, and we're going to get to that in just a minute. So again, you take your cash, divide that by whatever your monthly payment is, and that's your debt coverage ratio. That's how much cash you have available to cover the debt, to make the monthly payment, right? So in this case, we're looking very good in terms of a debt coverage ratio. As I go out into the timeline, though, look what happens, and this is really important. This is why doing projections are really important. Is you look out into the timeline and you see, oh, but wait a minute, going out into the future or going out later on in the timeline, we're not only not looking that great, we're actually, well, we're in a negative cash position. So obviously we have nothing from which to cover the debt. Looks like in the following month we recover, but still much lower numbers comparatively speaking. And then it looks like our cash position starts to improve dramatically once again. And by December, the line of credit's been paid off according to the schedule, which is why there's nothing to look at here and everything goes down to 0. But again, if you haven't already, pause the video and go through this just like I did. Rewind and replay if you need to follow along. I know I can go fast sometimes, but you know, the point is to go through this and understand. You should be able to explain this to your client the way I've just been able to explain it to you. That's how clear you need to be on this. And the more clear you are, the more able you are to explain it with so much confidence because you understand it so well, the more confidence your client's going to have in you and in terms of what decisions you feel you want to guide them into making with respect to business financing and making sure they have the capital that they need to take advantage of any and every possible opportunity that comes their way. So now let's look at where does the payment, where did I come up with this information from? Well, again, deferring to my research, which was almost entirely derived from what my friend Meredith at Fundera had provided me with, she explains that typical you can get on the lower end 8%, on the upper end 15% of your annual revenue is what companies will lend your company. So looking at annual revenue, let's say of $250,000, the lower limit of that translates to $20,000 at 8%. Again, simple math. 250 times 8% gets me $20,000. On the upper end, I might be able to get $37,500. Again, a lot of this, the difference where I wind up with the lender is going to depend on how much confidence I build on their part in my ability to repay them. Right? The more confident they are, the more likely they'll be willing to lend me more money. So using this information, I've come up with two different effective interest tables here, and it's an important distinction because one is really for the line of credit, which, as I mentioned, is my favorite. It's the one I want you to have, if at all possible, because you can use it and reuse it over and over and over again. It doesn't go away once you've paid it off. Whereas any other kind of loan is what's called a term loan, which means I borrow it, I repay it with interest, and then I'm done. I might have to, if anything, I'd have to go apply for a new loan afterwards or in the interim if I need more financing. With a line of credit, it's revolving, so I can borrow from it, pay it back, borrow again, pay it back, and if things are going well, I'm sure I can ask for an increase in my limit on that. And the banks like to see you active with them. When a bank gives you a line of credit, again, going back to those covenants, sometimes they'll actually require that you remain active with it. In other words, you can't just get the line of credit and then not use it. It might seem like that would be a savvy business thing to do, is never use the line because you don't actually need it, but it's there in case you do. The banks say, we're locking up money on our end to make sure that it's available for you in case you do need it. In other words, you need to sort of make it worth the bank's while to provide you with that financing, which means you need to use it. Plain and simple. And from what I've seen in my own direct experience, it can be subjective, frankly, in terms of, well, what do I need to do at a minimum? It's not always clear. Usually it's vague. The bank just says there needs to be activity, right? So worst comes to worst, you borrow from it 1 month, pay it down the next, and just keep doing that. And as long as the bank doesn't come to you, usually you're going to have somebody with whom you have a relationship at the bank who provided you with this line of credit. As long as they're not calling you saying, hey, you need to show more activity, then you're probably just fine. So it's an important distinction because of what follows here. So I used the $20,000 as the amount borrowed based on the scenario of $250,000 and being able to borrow what was at the lower end of that limit. That's where I sourced these numbers from. And in terms of that, I looked at and I just picked 6%. Don't ask me where I got it from. I may have even jumped into bankrate.com to get an idea of what rates look like right now. I honestly don't remember where the 6% came from. I may have just made it up. And Fundera, by the way, has a lot of resources here so that you can probably go on their site and look at prevailing lending rates and things like that along their lines. If not, now that I just said that in front of the whole world, maybe they'll have to. But it wouldn't be a terrible thing. And like I said earlier, Fundera has been great about not just creating a product, but creating the resources around their product that help you better understand what it is that you're ultimately going to do with a product like theirs. In other words, they've provided a lot of resources that help you understand the whole lending process and everything that goes with it much better. So definitely spend some time, even if you don't think you need a loan, even if you think you're never going to need a loan, but for some reason you decide that you want to be better educated about the world of business loans, then you need to hang out here with Fundera. No question about it in my mind. So back to the rate, let's just assume 6% is what you're going to get. It could be more, it could be less. Notice it's gray and blue in the template, which means that's something that you can change. And so if you think 4.75% is more realistic, by all means change it. I also lay it out in a way that allows you to account for a fluctuating rate or a variable rate, right? So not all loans are fixed. Lines of credit, I imagine, definitely can be subject to change. A lot of times it's going to be based on prime plus something, right? Prime is the prime rate that the government establishes for lending rates. So again, I built the template in such a way that you can go month to month and change the rate just in case that's necessary. In the meantime, whatever you set as the first month's rate will automatically, everything's set equal to that until or unless you go in and say, oh no, in April it's going to be 6.75% or whatever it is. The clear distinction, though, in terms of how things are structured between the line of credit versus the term loan is really, I think, exemplified by the way I've got it laid out here. I'm going to decide how much principal I pay off each month. I might decide that I'm only going to pay the interest at first after I've borrowed the initial $20,000. But as you can see, what I've done here is I said, let's do a plan that says we're going to pay $2,000 back plus the interest each month, right? So that our monthly payment, our total monthly payment, is the variable here, right? Based on whatever I establish as the amount of principal that I want to pay. Obviously, I have to pay the interest amount at a minimum, right? So here, that's the variable, is the principal amount that we're going to pay. And looking at this and looking at 6% as the per annum rate, if I pay $2,000 a month, then the line of credit is paid off, as you saw earlier when I was looking at the ratio analysis, by December. Right, so in the last month, on November of 2020, we'll have this line of credit paid off. That's assuming I don't come in and borrow money back. Again, that's the beauty of the line of credit and the beauty of having cash flow projections. I might look in ahead of time and say, hey, you know what? At this point in the timeline, in June based on our best estimates. It's looking like our line of credit's going to be down to ending principal of $10,000, which means we've got $10,000 wiggle room. We can borrow back $10,000 here. And looking at our big picture cash flow projections, maybe we determine that we're going to need that. So we plan the borrowing. And let's plan on borrowing $5,000 here. So you just add that into the amount borrowed line, and everything updates from there, of course. And now we're back to paying $2,000 for at least another couple of months. That's the beauty of having a template like this and how it works. Now, last and certainly not least, we're going to look at the other side of this coin, which is the term loan and what that effective interest table looks like. And the difference is now your total monthly payment is the variable, because that's what it's going to be. Your monthly payment is going to be your monthly payment, and that's going to be that. And the difference is going to be that as each month goes on and you make your monthly payment, the amount of interest that you're paying is less because the interest is based on the principal. So since the principal amount decreases each month, the amount of interest that you pay on what you owe, since what you owe is less, the amount of interest that you pay is less. In other words, it shifts, and as time goes on, you're paying less interest and more principal out of this. And I probably need to copy the formula over because I neglected to do that so you can see what that looks like. So notice in the first month our principal is actually only $1,900 plus the $100 of interest, and you can see this very clearly now that the interest amount decreases, the principal amount keeps increasing until we get near the end where the interest is almost nothing and the principal amount is almost the entire payment that we're making each month. So I provided you with templates for both scenarios, the line of credit, and I should change the description here, and this is just the term loan, right? And that, my friends, is almost everything you need to know about business loans. As always, if you have any questions, please post them in our answers forum right here at schoolofbookkeeping.com. That's available to registered scholars only. If you're not a scholar, become a scholar, and then you can use our answers forum. And that's where I monitor every day, all day long. That's all I do is I stare at that, waiting for you to ask your questions. And then when you do, I respond almost immediately, or certainly within 24 hours in most cases. So I hope that you've learned something here and had some fun along the way. And next, now that you understand the whole world of business loans much better, what we're going to look at is how Fundera really helps with this process, because one product will enable you to take all these different loan types, see which ones might meet your client's needs, and apply for them all from one place. That, my friends, is the beauty of Fundera. That is what you're going to see in the next lesson. I look forward to seeing you there. Now that you understand almost everything you need to understand about the lending process, we can start to take a look at the actual lending process, or the application process, I should say, with Fundera. We're going to finally take a look at the product that this course is about.